Only 1 out of 5 teens has started investing in the United States, and the numbers are even more discouraging in other countries. If you're watching this video as a teen, congratulations. You may already be ahead of 80% of your age when it comes to financial education. But the question is, are you ready for investing? See, investing is more than just putting money aside. It's about understanding your finances, your future goals, and the tools that will get you there. So before you dive in, ask yourself these questions to assess your readiness. Do you have money from a job or another source that you will not need immediately? Can you afford to lose this money if your investments do not go as planned? If you're under 18, do you have a parent or guardian willing to help you invest? Do you fully understand the investment you are considering and how it works? If you get no to any of these questions, you need to reconsider your position and prepare yourself until you pass this benchmark with yes to all the questions. Now, it is very important to be clear about what you are doing. So be sure that you are investing, not saving, because investing and saving may seem similar, but they serve very different purposes. Saving is about setting money aside for short-term needs or emergencies. It's about security, knowing you'll have access to your cash when you need it. On the other hand, investing is a strategy to grow your wealth over the long term. Here, your goal isn't just safety, it's growth. Now, if you are confused about whether you should save or invest, let's address that problem first. Saving is best when you need quick access to your money, whether for an emergency fund, a short-term purchase, or a financial cushion. It is reliable, low risk, and gives you peace of mind. But the downside? Interest rates on savings accounts are usually very low. The money you save does not really grow, and inflation can slowly chip away at its value. For example, if you save like $1,000 in your bank account for one financial year, suppose the inflation that year was 9%. At the end of the year, you will have your $1,000 there, but their power dropped by 9%, so technically you now have just $900 left. Now, the investing part. Investing comes into play when you are thinking long-term, years or even decades. Investments in stocks, bonds, or other assets can help your money grow significantly over time. The biggest advantage of investing is compounding. Your money earns returns, and those returns generate even more returns. Sounds like the best deal, right? But here's the catch. Investments can be risky. Market downturns can lead to losses, especially in the short term. That's why it's important to only invest money you won't need immediately. The pros of saving are security and access to the money whenever you need it, but your returns will be minimal. The pros of investing are the potential for growth and wealth building, but it comes with the risks of losing money if the market does not perform as expected. But even if you are going to invest, this video is going to teach you a lot about it anyway. Now, let's see how, in 5 simple steps, you can start your investing game as a teenager. Number 1, invest in personal development. You can't make good financial decisions without knowing the basics. Think of it this way. The best investment you'll ever make is in yourself. Spend time reading books like The Simple Path to Wealth by J.L. Collins or I Will Teach You to Be Rich by Ramit Sethi. These books will change the way you think about money and help you lay a solid foundation for the future. And it's not just about finance. Learn new skills like coding, design, or communication. These abilities will pay off in ways you can't even predict yet. The more you invest in improving yourself, the more prepared you'll be for bigger financial decisions later on. Next, open a bank account. This is your first real step into the financial world. Get an account in your own name, preferably with a high-interest savings option. It's not just about storing money. This is where you'll start building financial habits. You will quickly learn the importance of keeping track of every dollar. If you start early, these habits will become second nature. Also, this is the time to understand your own risk appetite and spending habits. Like the money is sitting right in your bank, and how you spend it and save it for the rest of the day says a lot about you. The next step you can take is to make yourself familiar with different options. You cannot possibly jump straight into the investing and let the other guy do it for you. You can make an investment account for free on many platforms and start exploring the companies you have heard of. You can also start paper trading and invest with the virtual currency. Think of it as a safe, no-risk environment to try out your strategies. You can track real stock performance without putting your money on the line. This is probably one of the best ways to test your abilities, greed, and risk tolerance. Now, while you are practicing, understand the importance of diversification. For example, you get 100K in virtual cash and decide to invest in Bitcoin and cryptocurrencies. The next day, you wake up only to find that the crypto market crashed, and now your 100K is 70K, while someone who invested in stock made 20% profit. Had you invested in both stocks and crypto, you could have easily hedged your loss. Therefore, You don't want to put all your money into one basket. Spread it across different areas like stocks, bonds, index funds, and even crypto. Each of these assets behaves differently in the market. Stocks may offer high growth, but come with higher risk, while bonds are safer but provide lower returns. Index funds give you exposure to a broad market without requiring you to pick individual stocks. Crypto, risk is even higher, but it can be an exciting way to explore new technology like blockchain and Web3, and might even go 30% a week. The key is balance. Understand your financial goals and risk tolerance, then build a portfolio that aligns with them. The point is, diversification reduces risk, and you have to eventually master it. The fifth step is crucial. Ask yourself a source of money that you are willing to invest. Investing is more than just numbers on a screen. It's about understanding the value of money. If you are getting it as pocket money from your parents or earning from a passive source, you will not be able to understand the value of it. The best way to do this? Get a job. Whether it's part-time work while in school or a summer gig, a job teaches you the true cost of earning and spending. You'll start to see why saving and investing matter so much. Plus, real-world work experience helps you build critical skills like communication, problem-solving, and time management, all of which translate to better financial decision-making. By working and managing your money from a young age, you will be more prepared to handle larger financial responsibilities as you grow older. In short, start with personal development, open a bank account, test your strategies, invest in diverse assets, and gain experience through work. Now that you know how to get started, let us talk about what you can invest in. The good news is that there are several options out there that are perfect for beginners, especially teens looking to start small. You can start exploring the index funds, which are a fantastic starting point. Why? Because they offer instant diversification. Instead of picking individual stocks, which can be risky, index funds spread your money across hundreds of companies at once. Imagine investing in the entire top 500 companies in the US with just one purchase. This reduces your risk while giving you a piece of the overall market growth. Plus, you don't need to be an expert in picking stocks. Just let the index fund do the heavy lifting and understand the process while they do it for you. Next, you can consider stocks. Owning stocks means you own a small part of a company. If the company does well, your stock value can increase, giving you returns over time. But with that potential comes risk. Stocks can go down in value too. The key here is research. Look at companies with strong long-term potential. Remember, if you start early, you have time on your side to ride out the ups and downs of the market and experience it deeply. You can also explore bonds. Bonds are another option, something more stable. When you buy a bond, you're essentially lending money to a company or government, and in return, they pay you interest over time. Bonds are less risky than stocks, but they offer lower returns. And yes, even crypto can be an option. Cryptocurrencies like Bitcoin or Ethereum are digital currencies that have gained a lot of attention. Now, here's the thing. Crypto is highly volatile. Prices can shoot up or crash dramatically in short periods, so you can experiment with it but not rely on it and invest a major part of your portfolio. However, investing a small portion of your money in crypto can be a way to learn about this new asset class and possibly benefit from its growth. Just be cautious. Don't invest more than you can afford to lose. Diversification isn't just about picking different asset classes. It is also about picking assets with different risk profiles. See, the assets with higher returns will always have higher risk and vice versa. So, you must include a small portion of assets with higher returns like crypto in your portfolio. Starting with these investments as a teen means you will have the chance to learn, grow your portfolio, and adjust your strategy as you gain more experience. Do you know the best thing about investing as a teenager? You got the time to make it big through compounding. Compounding is when the money you invest earns interest, and then that interest earns more interest. Over time, this creates a snowball effect where your money grows faster and faster. If you invest $100 with a 10% interest rate, you will get $10, and your portfolio will be $110. The next time, this 10% will be $11 instead of $10, and the portfolio will be $111 and keep growing forever. Want to taste it? Let me show you some real calculations. Let's say you start with just $100 and invest $100 every month for the next 20 years. Now, suppose the annual interest rate is 10%. So what happens in 5 years? In the first 5 years, you will deposit $6,000 and you will get interest of $1,872. Not so great, right? Let's move on to 10 years. You will have deposited $12,000 and you will get interest of more than $8,000, so your portfolio will be now $20,000. Now, fast forward to 20 years, this is where magic happens. By the time you hit 20 years, your total balance reaches over $77,000. Look at that jump. Your original deposit amount was $24,000 over those 20 years, but you've earned over $53,000 in interest alone. At this time, your interest will be more than what you are depositing. It took you 20 years to earn around $50,000, but you know how much time it will take to make another $50,000? Only 5 years, next $50,000, 3 years. And then there will be a time when you will be earning $50,000 each year. Now, look at this chart. The blue area shows the amount you deposited, and the orange area, which is growing, more shows the compounding effect on your amount. The key to this entire strategy is time. The longer you leave your money invested, the faster it grows. So what does this mean for you? The sooner you start investing, even with small amounts, the more time you give your money to grow. Financial literacy is the key. The better you learn it, the more money you can make from investing. Before you leave, here's a quick question for you. If you had $10,000 at the age you are, what would you do with that? Spend, invest, or save? Let me know your answer in the comments with your age. If you liked the video, give it a thumbs up, and don't forget to subscribe to the channel. See you in another video.